Hello and welcome back to Dukascopy TV. Well, the great rotation, as it were, has finally happened out of bonds, but this is to much of the dismay of some hedge funds. Here to discuss the situation is Katherine Hill. Katherine, pleasure to have you back in the studio.
Glad to be here.
Now, if we look at this situation, some funds are saying that they now need more capital and more risk appetite, in order to be able to trade successfully. But how would you describe how hedge funds have performed since the start of the year, perhaps?
Certainly. So since the beginning of this year, hedge funds have done pretty well, and there are some strategies that have posted double-digit returns. What's interesting, though, is that the hedge fund inflows haven't matched the performance. So since the beginning of the year, hedge fund inflows have been basically flat. I mean, a slight increase. But that's surprising since the performance of hedge funds has done well, but we all think the reason why is because the stock market has done well. And an investor thinks, well, why should I pay a hedge fund manager all those fees if I can invest in an ETF, in a mutual fund, in a long-only strategy, in an index? And so that says a lot about investors, how they feel about hedge funds right now.
Well, you said that since before June, that the stock market was doing well, booming, historic levels. But how would you describe the impact since June? What's really happened and how it's affected your industry?
Well, the hedge fund industry has posted it's red across the board for the month of June. And that's because the stock market hasn't done well. And that was because the Fed had announced that it may be pulling back its stimulus. That upset the market. It upset hedge fund managers. They had to rebalance their portfolios. There was a lot of volatility, and they weren't prepared. And when they're not prepared, they lose money. And that's what happened. Now, there were some individual managers who actually posted positive results, and good for them, but the majority did not.
The majority certainly felt it, but something that then becomes prevalent is this hedge fund secondary market, is that right? So could you tell us a little bit about that, please?
Absolutely. So the hedge fund secondary market really boomed during the financial crisis. Investors needed to get their capital back, and it was locked up in a hedge fund, or hedge fund managers actually created side pockets. They had liquidating vehicles, and investors were stuck with these shares having no ability to get out, so they thought. The secondary market helped. Investors were able to trade their shares, and that is still around today, but now people are using the secondary market also as a portfolio management tool, similar to how private equity investors use the secondary market. So it's evolving and changing.
And how has this affected private equities? I mean, some people are still saying that they are expecting deals, but it does raise the question as whether everything that you've mentioned is going to negate for fewer deals. So what is your outlook for this sector?
Well, there have been some recent statistics published by Capital Dynamics and Merger Market that the past year has seen a 25% drop in the number of usual deals, and actually last quarter alone was the worst in the past 3 years for deals in private equity. That's not good news, but there has been a flow into private equity, but a majority of that flow has been in secondaries. So I was speaking to one of the largest pension funds in the world yesterday, who's allocated $5 billion to secondaries, and in the next few years they'll put $5 to $10 billion more into secondaries. So that says a lot about that market. There's confidence in buying in secondaries. And why would anyone do that? Well, the thing about private equity secondaries is that you have an ability to manage your portfolio. Let's say you're overexposed to a certain geography or industry, or well, it helps mitigate the J-curve effect, but also you can get access to older vintages that maybe you weren't able to invest in when they first launched. So this is a really a good way to access those managers that are, well established, that an investor just may not have been able to.
Now, this is all very topical at the moment, very prevalent. Another word which is legislation. You can't really go anywhere in the financial industry without avoiding this more legislation, increased legislation. But how is it impacting these things which you were talking about? Is there any new changes or new trends, would you say?
That's a really good point. The Volcker rule and the Basel II and III will directly impact the secondary market, because banks can no longer have private equity funds on their books. They can't sponsor them, which means all these banks are going to have to get rid of their positions. So that then means they're going to flood the market, and all those other investors will be able to pick up some really good funds.
Very much so. I mean, but just for like one last tip, how would you say, what was your tip in terms of go secondaries, or would you go private equities? What's your certain?
Well, I would say this. The secondary market can move very quickly, and investors need to be prepared. So once a fund that they want comes on the market, they need to be able to react very quickly in order to buy those shares.
Katherine, thank you for sharing your perspectives with us. Pleasure and interesting as always, and great to hear that there is still some opportunity out there.
Thank you, Monica.
Thanks. Well, that's all from myself and Katherine for the moment. Click back to DukascopyTv to see today's weekly wrap-up, taking in all of the major headlines. Goodbye for now.